Silver investors, if you think I own silver just because you see a ticker in your brokerage, the last crash proved that's an illusion. Two funds, SLV and PSLV, both moved with the silver price on the way up, but when silver collapsed 36% in days, one traded at a discount and its arbitrage broke, while the other kept a premium because investors trust its structure, not just its chart. I'm OG John AG, and in this video I'm going to show you, with hard data, why one silver ETF failed the stress test and one passed, how SLV quietly built an unallocated silver problem into its own prospectus, what PSLV does differently with fully allocated bars and real redemption rights, what this means for the next crisis and a possible COMEX delivery crunch, and how to decide which ticker fits your strategy before the system decides for you. Segment 1. What the 36% silver crash actually revealed. Let's start with the crime scene. In the recent silver wipeout, spot silver went from around $122 to $63, a 48% collapse peak to trough. On one of the worst days, SLV, the biggest silver ETF on earth, dropped about 28% in a single session. Bid-ask spreads blew out, and trading halts hit multiple times. Here's the punchline. SLV traded at a discount to its net asset value, NAV, during and after the crash. PSLV, Sprott's physical trust, continued to trade at a premium over NAV, even at the bottom. Same metal, same market, two products telling you completely different things about how investors view their structures. The crash was a stress test, and the market voted with real money. It treated SLV shares like a trading product that might not be fully backed or reliably redeemable. It treated PSLV units like a proxy for real bars in a mint vault, worth paying extra for. That's not theory. Those are observable price gaps you can pull from public data. Segment 2, Round 1, Structure, Grantor Trust versus Physical Trust. On the surface, both tickers look similar in your app. They say silver, they move roughly with spot, and they sit in the same portfolio list. Under the hood, SLV, iShares Silver Trust, structured as a grantor trust. Custodian, a large bullion bank, JP Morgan historically, operating under a standard ETF model. Only authorized participants, APs, big banks and dealers can create or redeem shares directly with the trust. PSLV, Sprott Physical Silver Trust, structured as a closed-end physical trust. Silver stored as fully allocated, segregated bars at the Royal Canadian Mint, a crown corporation. Retail holders can, above a set unit threshold, redeem for physical silver bars through a defined process. So SLV is built first as a price tracking product for institutions. PSLV is built first as a vault with a ticker for people who care about bars. That structural intention is why they behave so differently under stress. Segment 3, Round 2, the unallocated silver problem in SLV. Now the detail almost nobody reads, unallocated silver in SLV. From SEC filings and flow analysis summarized in the video, SLV typically holds about 3 to 5% of its silver as unallocated, essentially IOUs from the custodian, not specific bar numbers. Under heavy inflows, that can rise toward 18 to 25% unallocated if they struggle to source bars fast enough. Think about that. If SLV has, say, 500 million ounces reported, up to a quarter of that could be unallocated in a crunch, accounting entries, not specific bars sitting on racks. Why does that matter in a crisis? If physical silver is genuinely scarce and redemptions surge, unallocated ounces are not a pile of metal you can load on a truck. They are claims on metal that may not exist in sufficient size. In that scenario, the trust has 3 options. Scramble to buy real bars at any price. Delay or ration redemptions. Invoke extraordinary market conditions language and suspend redemptions. That third option is exactly what the video argues is most likely if SLV hits 20% plus unallocated in a physical shortage. They will not charter planes to fly in metal that doesn't exist. They'll freeze redemptions to protect the structure, not you. Meanwhile, PSLV's model is simple. They do not issue new units without already having physical bars. If they can't source metal, they stop growing. If redemptions come in, they deliver bars until the vault is smaller. One structure quietly builds an unallocated buffer that explodes under stress. The other refuses to create that buffer in the first place. Segment 4, Round 3, who can actually get silver out? Redemption rights are where the two diverge hardest. SLV. Only authorized participants can redeem, and only in very large creation units, tens of thousands of shares corresponding to roughly 50,000 plus ounces. Retail investors, you, cannot submit SLV shares and ask for bars. In a squeeze where physical is scarce, APs are incentivized to redeem to get metal for themselves, or for COMEX, or for industrial buyers, not for you. If redemptions are suspended under an extraordinary conditions clause, nobody can pull metal out, not even APs. The ETF becomes a closed pool of claims trading at whatever price the market assigns. PSLV offers documented redemption rights for holders above a certain size, roughly enough units to claim 400 1,000 ounces, depending on bar size. Always check current terms. Sprott explicitly markets PSLV as a way for individuals and groups to eventually convert units into bars. In the stress scenario, the video modeled, SLV sees soaring unallocated, redemption pressure from APs, and finally a redemption freeze. PSLV continues to operate its redemption mechanism for those who qualify, even as units trade at rising premiums. Result, SLV holders are stuck in paper hoping the ETF price keeps tracking spot. PSLV holders still have a door, narrow with rules and costs, but a door leading to actual bars. Segment 5, Round 4. Premiums, discounts, and what the crash proved. Premium discount data during the crash was brutal and very revealing. From the transcript, during the 36% silver crash, SLV traded at a discount to NAV, and that discount persisted even after the dust settled. PSLV traded at a premium to NAV the entire time. The market was willing to pay more than intrinsic value for a claim on its vault bars. Why? Because in real time, investors were asking, which structure do I actually trust if this gets worse? Their answers expressed in price. SLV's discount. We are not fully convinced every share equals a safe, deliverable chunk of silver. PSLV's premium or custodians, we value the link to specific bars and redemption rights enough to pay extra. Sprott's own research and third-party tools show PSLV's premium tends to expand when physical silver premiums in the real world explode. SLV has no natural retail arbitrage mechanism when it trades below NAV because you cannot redeem it. So in stress, PSLV's structure anchors it to physical value. SLV can float away from NAV and stay there. The crash didn't just drop prices, it ranked structures in the eyes of real money. Segment 6, Round 5, COMEX, SLV as backstop, and the emergency vault problem. Now the darker angle, SLV as a COMEX backstop. Separate tracking in another video shows SLV lost about 38 million ounces in 20 days via redemptions, roughly 1.9 ounces per day. At the same time, COMEX registered silver sat at multi-year lows around 100 million ounces. Interpretation. Authorized participants redeemed SLV shares for metal, then used that metal to backstop COMEX delivery obligations. SLV's 490-ounce vault effectively became an emergency pool to keep the futures system alive. That creates a new risk. If SLV vaults continue draining to rescue COMEX, SLV holdings shrink rapidly. Remaining investors are holding a trust that is quietly being tapped to plug systemic holes. In a true shortage, SLV could hit a point where continuing to honor redemptions for APs threatens the integrity of the trust. At that point, as Wealthmark's breakdown puts it, redemption suspensions become the rational move. PSLV, by contrast, does not operate as a COMEX backstop, does not issue shares without already having allocated metal. If it cannot source enough, it simply stops expanding, not quietly build unallocated. So in crisis, SLV is pulled between ETF investors and futures obligations. PSLV's only job is to represent its own vault. Segment 7, Tax and PFIC, boring but huge for serious money. The video also hits a point bigger investors care about, tax treatment. In the US, SLV is generally treated as a grantor trust holding a collectible. Long-term gains can be taxed at collectibles rates, up to 28%, not standard long-term capital gains. PSLV, as a foreign PFIC, passive foreign investment company, can trigger Form 8621 requirements and special reporting. Done wrong, that can be a headache. Done right, for example, electing qualified electing fund treatment when appropriate, it can lower effective tax on gains compared to direct physical. Wealthmark's example. Over a big move, the tax treatment difference between SLV and PSLV could mean saving 5 figures, $13,000 plus, in tax on the same nominal gain. The point isn't to give tax advice, it's to say, these funds are different legally, not just structurally. For bigger allocations, your accountant will care about PFIC 8621 and collectibles rates almost as much as you care about premiums and discounts. Segment 8. Who should hold which? A practical framework. The video finishes with a very clear role-based breakdown. SLV is better suited for short-term traders, people running option strategies on silver. SLV has very liquid options, those who want tight bid-ask spreads and don't care about ever touching metal. Pros: huge daily volume, easy to enter, exit, very close tracking to paper spot in normal times. Cons: unallocated risk, redemption rights limited to APs. Redemptions can be suspended under stress, leaving you with a pure paper asset. PSLV is better suited for long-term stackers and wealth preservation investors, people who ultimately want a path from ticker to bars, even if they never use it. Those who are okay with some premium and paperwork in exchange for allocated metal and government mint custody. Pros: fully allocated bars at a mint, redemption rights for qualified holders, Premium behavior that aligns with physical shortages. Cons. Can trade at a premium or discount. Less liquid than SLV. More complex tax reporting for U.S. investors. And above both, as the video repeats, the hierarchy of safety is still physical in your own custody. PSLV, similar fully allocated vehicles. SLV and other large, partly unallocated ETFs. You're not wrong for using SLV. You're only wrong if you think it's the same thing as owning 1,000 Oz bars with your name on them. Segment 9, what this means for the next crisis. Pull it all together. We've already watched a 36–48% silver crash where SLV went to a discount and its arbitrage mechanism struggled. PSLV kept a premium because investors trusted its metal and redemption rights. We've seen SLV shed 38 ounces in 20 days, acting as an emergency vault for comics, a role PSLV doesn't play. We have documented language in SLV filings that allows redemption suspensions in severe stress, while PSLV is explicitly marketed as a physical-backed trust with unit holder redemption. In the next physical silver crisis, not if, but when, the key question won't be what's spot today. It will be, can I still get metal out of this structure? Does the market trust this fund's bars enough to pay me NAV or more? The last crash already answered those questions once. You don't need to guess which ticker investors trusted more when everything was on fire. The premiums and discounts already told you. You've been watching John AG here, and I'm OG John AG. If this helped you see why I own silver ETF can mean two completely different realities depending on three letters, SLV or PSLV, hit like so this kind of under-the-hood breakdown doesn't get buried. Subscribe and turn on all notifications, because in the next real silver squeeze, the structure you chose years earlier will matter more than any price prediction you hear the week it hits.